Thank you very much. It's an honour to follow a doyen of our industry. Greg, thank you. There's a lot of really sexy, interesting tech, venture, crypto and other things that you'll hear about today. I come from that world. I put the first Australian tech company on NASDAQ 20 years ago. The first tech unicorn, took it to 14 billion in market cap, which was real money in those days. And then the challenge is to preserve your wealth. And that's why I got interested in property. I want to take you through something which I think hits the heart of the missing middle of most of your portfolios. If you want to put 2% of your portfolio into crypto, knock yourself out, or 10% into venture and PE. You'll have some cash, you'll have some fixed income. But I think for most of us, what we're trying to do is compound our money in the low to mid-teens, quadruple our money every 10 years with a minimum of risk. And property potentially provides that opportunity. And residential property is one of the stablest asset classes to enable you to do that. So what I'll take you through today is how we can allow you to use the stability and growth of residential property to deliver mid-teens returns with what I think you will acknowledge is a lower risk stack than the alternatives for that missing middle of your portfolio. I'm not saying you shouldn't invest in equities or private credit or other things. They're all worthy and I have money in those too. But for meat and potatoes, mid-teens returns with low risk, a portfolio of $2 million family homes across Sydney, Melbourne and Brisbane is about as low risk stack as you can get. You sit there and watch grass grow while these things double in value every 10 years. So let me take you through that. LongView, the business I've been building with my partner Anthony Cohen for the last 10 years, we do nothing but residential property. We don't build it, we focus on the existing homes. Every property market in the world is a trade-off between capital growth and rental yield. The capital growth is largely in the land, the rental yield is largely in the building. Australia is the best capital growth market in the world, Australian resi, and as a consequence, very low yield. So if you want to make money in Australian resi, in family homes, in that biggest asset class in the country, you need to learn how to harvest capital growth. And so the missing middle in the property investment market in this country is the ability to invest in existing family homes. There's every layer of the capital stack available for you in new home construction, whether that's equity in the big home builders through to, prime, mezz debt, everything else in between. That's 3% of the $11 trillion in resi. New home development. That's essentially a manufacturing business where you hope to sell things for more than it costs to make them. And if you do that well, you make good money. If you don't, things can end badly. Huge risk stack in there. Construction risk, financing risk, market risk, weather risk, the CFMEU, and God knows what else. What you don't have investment grade opportunities for right now is quality family homes on well-located land. The only way you can do that is what almost everyone in this room does, which is own one and live in it, which is one of the better investments you're going to make, risk adjusted and tax adjusted, or sometimes being a landlord. Now at LongView, we're probably the top ranked rental property manager in the world, in the nation, I won't say the world. We've won 11 state and national awards, helping 4,000 landlords rent out their rental properties for the last 10 years. And as a consequence, we know that that's a lousy way to invest your money in quality family homes. You've got land tax, you've got vacancy, you've got maintenance, you've got lack of diversification, you've got all those things. So no one knows better than LongView the challenges of being a landlord. We do a better job of looking after landlords than anyone else, but for the last 4 years we've been taking that knowledge and my skills from, and Anthony's skills from, McKinsey and Silicon Valley and saying, how can we make this work better? How can we give you access to the $8 trillion that is equity in Australia's family homes and turn it into an investment grade asset class and deliver mid-teens returns with remarkably low risk? Just to kind of qualify that for you. Let's be clear. The capital growth, just the capital growth, not the underlying value, not any rental yield, nothing, just the capital growth in Australia's family homes and Australian residential property last year, this year and most other years, as Greg outlined, is the same size as the entire federal government budget. That's 4 times the size of all the earnings of every company on the ASX combined. And yet there is no investment grade fund to give you exposure to capital growth in family homes. You've got to do it all one by one, like my 4,000 landlords. So that's what the LongView Home Equity Fund is doing, giving you exposure to a diversified portfolio of quality family homes to deliver mid-teens returns at low risk. Let me explain a bit about how we do that. We've got a data science team. This is where the Silicon Valley side comes in. We've analysed every sale price of every individual property in Australia for the last 50 years to figure out where the capital growth is and where it isn't. All boats do not rise. Greg mentioned quite correctly, new build apartments, for example, just catastrophically hopeless capital growth and actually pretty low yields by global standards too. You'd be better off in the Sun Belt of the US. Okay, simple reality. 1/6 of all the residential properties in this country generate half the capital growth. I'm not saying there aren't others where you can make money. I'm just saying let's fish where the fish are. And I'll tell you where the fish are because you all live in them. The quality family homes of Sydney, Melbourne and Brisbane, what we call Rodwells. Robust, older dwellings on well-located land. Okay, land appreciates, buildings depreciate. This is not complicated. So if you can invest in those quality homes in good locations where the land value underneath the home is the guts of what you're buying, that's what's going to grow in value. And it's grown in value for over 100 years. Why? Because of our unique demographic structure and the unique economy, as Greg outlined, that we've built around it. We have the second highest population growth rate in the world. And we concentrate that population growth almost entirely in just 3 urban centres, Melbourne, Sydney and Brisbane. And what that means, as Mark Twain would say, they ain't making any more land. If you stick an MCG and a half worth of people in Melbourne every year, 160,000 people, then funnily enough, the value of well-located suburban land keeps going up because they've got to live someplace. Same in Sydney and increasingly the same in Brisbane. So those Rodwells, I've trademarked that by the way, those Rodwells of Sydney, Melbourne and Brisbane, that's a massive investable universe for us. That's about 1.7 million homes. There's no shortage of assets we want to invest in. And if we invest in these, they're remarkably stable. You know, peak to trough, Australian resi prices have never dropped more than 12%, and that was over a leisurely 2-year period and picked it up in the third. And that is since the one and only actual housing crash this country's ever had, contrary to popular mythology, and that was in 1893. So it's been a while, okay? This is a long, steady climb. It's a long, steady climb when interest rates are up and interest rates are down. It's a long, steady climb with or without negative gearing, with or without Chinese money, with or without all the other things that people think impact house prices, because while all those things have some impact, the dominant impact by between 2 and 3 orders of magnitude is the impact of population pressure on the land underneath the homes. So, the LongView Home Equity Fund invests in quality family homes. We've currently got 64 in the portfolio, so that's roughly $100 million worth of property, so the average is a little under $2 million. These are not fancy, they're not full of gag-in-our kitchens, they're just quality family homes in good locations, the sort of homes that many of you live in. 78% of the value of these homes is the dirt underneath the home. Okay, I'm not getting up at 3 in the morning to see what happened in New York, right? I'm not worried about weather risk, finance risk, construction risk, market risk. I'm sitting here watching grass grow while these babies double in value every 10 years or better, okay? So that's my risk stack. Okay, well that's amazing. Normally for that risk stack you'd expect mid to high single digit returns, so why am I claiming 14%? Let me explain our mechanism. This is where it gets interesting. This is where we try and bring a bit of Silicon Valley and McKinsey innovation to a centuries old asset class. We're not buying these homes and renting them out. We're co-investing with the people that already own them. We're co-investing with homeowners in their family homes. So precisely because we've had such phenomenal capital growth, a huge number of Australians have got serious wealth, but all of it's under their backside in their home and inaccessible to them. And so for many of those people, and our clients are midlife, 45 to 59 typically, they'd like to get hold of a bit of that money to do something else with it, to invest in their business. Typically is the biggest cohort we have. People who want to put more money into their small business because they reckon they could get a better return growing their business. people who want to be the banker mum and dad for their kids, people who will be staying for another 6 or 7 years till they downsize and they'd just like to give the place a bit of a zhuzh, put a couple of $100 into a little renovation. People, sadly, and this is a huge need set, I'm sad about, but it's actually, I'm proud of what we do. A lot of folks going through divorce, you get there, the marital asset pool is too concentrated in equity in the existing family home. If one partner's hoping to stay in the home, often with the kids, they can't afford to buy out the other partner. That's bad for everybody. Now, if they can get access to some of that equity, as some of our clients have done, they can buy out the other person, they can get on with their lives, they can stay in their home. Okay, so that's why people take our equity. We're not a bank lender. This is not interest. I don't have 47 armies of bank lawyers finding 15 different ways to throw people out of their home or tell them what to do. This is their home. We just want to participate in their investment in their own home and give them access to some of that capital that they can use for a better purpose, while they give us the privilege of riding alongside them. And there's two elements to that that allows us to deliver mid-teens returns, despite the fact that we have no debt, we have none of those other risks. And that is this mechanism. So the first thing, which should be obvious to you, but for any of you refugees like me from the People's Republic of Victoria, it will be even more obvious. If 78% of my value here is land, then that 78% is going to get massacred by land tax, right? If I bought these homes, even if I bought these lovely $2 million family homes. But these are the client's principal place of residence. And while we have a second mortgage security that guarantees our contract, we're not on title. We don't interfere with their ownership. We don't interfere with their principal place of residence exemption, and we ain't paying no land tax. So just right off the bat, compared to being a direct owner or landlord of any of these properties, you're 265 bips better off per annum by investing through shared equity than buying the exact same assets as a landlord, let alone you're not paying maintenance, you're not paying rates, you're not paying insurance, you're not paying any of that stuff. The client was paying that anyway. It's no loss to them, right? So that's a pretty good start. The second start is, okay, we are friendly money. We don't have an army of banking lawyers chasing people down and telling them what to do, making sure the bank takes no risk and the client takes all the risk. We're sitting alongside the client. What do they do for us in return? They willingly give up a disproportionate share of something they don't yet have, which is their future capital growth, money they don't yet have. So a typical deal is we'll write an equity check to the client for 10% of the value of their home, and they will give us a 1/3 share of future capital growth. So those of you who can do math can understand that that's a 3.3x multiple for us. So if the underlying asset is doing 7 or 8, or sometimes better, annual capital growth, we've got a 3.3x multiplier against that. So that's what I call leverage without debt. Normally, to get that much leverage on your equity, you'd have to borrow 75% of the value of that home and be paying the bank and have the risk and cost of the debt. I've got no debt. I've got leverage without debt, 3.3x times on high growth assets. So we have leverage without debt, we have land without land tax. So when I say we can meet your needs for the missing middle of your portfolio for mid-teens compounding returns on a risk stack that's watching grass grow, that's how we do it. You cannot do this yourself. I honestly don't believe that you will buy better assets than we can buy with our data science team, with our 20-year qualified buyers advisors who've typically bought 1,000 homes in every one of these locations, who scrub every single asset before it gets to our investment committee. But even if you could buy the same quality of assets, even if you had enough money to buy this volume and a diversified portfolio across Sydney, Melbourne and Brisbane, as we have, you'd still make 400 basis points less return on those exact same assets if you were the landlord than if you were an equity co-investor with the homeowner. So that's how we do it. Most people get the math on that pretty quick, and they have just one question for me. Okay, you don't control the exit, so what's the cash flow for me? It's a very sensible question. Let me take you through that. There's a one-word answer to that, which is portfolio. If it was just one home, you'd have a whole lot of what I call tenure risk, right? Maybe they'll stay 2 years, maybe they'll stay 50. But once you've got a portfolio of hundreds of homes, and you can see this in the US. The US has got a huge home equity investment sector that's grown in the last 10 years. You've got 3 or 4 big players and 7 or 8 smaller ones. They've got 10,000 plus homes right? They've been delivering 17 to 19% returns to their investors. And frankly, there's a lot less good capital growth in the US than there is in this great nation for the reasons I outlined. They're securitising the back ends of the book. So this all works. This is a closed-ended fund. The reason we've done that is not to keep your cash from you, but to get it back to you quicker. Because there's two ways you get your money back. Either the client sells their home, and many of these clients will be selling their home in a few years, or they buy out our contract. And particularly as interest rates go down, house prices go up, that's good for us. The cost of buying us out goes down, so that's good for the client. So like in the US, where the home equity funds, 50% of them get their money back from clients buying out the contract, 50% come from people selling the home. And because we're with midlife homeowners who are going to be downsizing anyway, both of those things drive cash flow. So we don't recycle capital for 2 years, but after that, every time a contract is realised, either through sale or buyout, that's packaged up every quarter and returned to investors. So that actually creates much stronger cash flows than you would have as a direct investor. It's a self-liquidating portfolio. The churn of contract buyouts and home sales actually ends up generating, we think initially 15+% money-on-money returns and then growing. At the end of the closed-ended period, whatever's left in the portfolio, which in the US has typically only been 5 to 10%, we're assuming here it'll be higher, but we want to be conservative, that tail of the fund then gets rolled into a new fund or securitised off the back end or debt finance, and the investors get the rest of the money out. So that's what we do. That, I think, gives you access to a meat and potatoes asset that you all understand through a unique structure with a highly diversified asset pool to meet the needs of the missing middle of your portfolio. So I know that'll raise a whole bunch of questions for you, but we think this sector is likely to grow phenomenally in this country over the next 10 years as it has in the US, and frankly this is a better market. But our team's at table 13, or grab the QR code, and we look forward to meeting those investment needs for you. Thanks very much.